Market volatility. This is going to be an investment quick take around volatility. And I'm noticing from some of the conversations that I'm having, people are getting nervous. And let's face it, it is perfectly normal to get nervous when there's volatility. The thing that we want to avoid is making an emotional-based decision to change investments significantly based off of short-term emotions that we're having. You know, when you want to change risk tolerances and those type of things, you really want to do it on your terms, when you're in control, when you can say, hey, I'm retiring now, I want to gradually reduce my risk. Or if you have a business that sells and you have a liquidity event and say, hey, I want to slowly, start to reduce my risk, and then set a glide path to being able to do that. A lot of questions or a lot of thoughts that are probably going through people's minds are like, hey, if there's a high probability that the markets are going to continue to go down, because in my newsletter, that's what we're talking about. We have the Fed raising interest rates into a slowing economy. We have fiscal tightening that's happening by Congress not passing any legislative stuff like the BBB, Build Back Better. And if you look from a rolling 1 year, we don't have any PPP loans, we don't have any airline bailouts, we don't have any of those things, which represents close to $1.3 trillion of spending. So we don't have those two, and you got this big geopolitical mess with Ukraine, Russia, and potentially Taiwan. And so if there's all this risk in the environment that you see, uncertainty, and you're thinking, hey, let me just pull out a larger chunk of my money and just have it in cash or be more conservative, some would say you're already too late to do that, because the time was at the end of last year and you've already taken some hit. What is shown to be effective is to risk manage around your risk tolerance. And what I mean by that is, let's say if you have 60% of your investment in equities, of that 60%, half of it is in US large cap stocks. Well, you don't have to own every sector in the large cap space. You could probably overweight things like utilities, consumer staples, which will still get, a bump up when the tide rises, but it is more defensive in terms of relative to other sectors like energy, technology, and that such. So, my thoughts on this really are from my experience of working with clients that, they feel a bit of pain, they feel a little bit more pain, and then they finally get to a point where it's like, I'm out, I want to get out of the market. They get out of the market, which happens to coincide with either the low or on the way down. They may feel good for a while, but you have to make that second decision of when to get back in. And a lot of them never make that accurately. Number one, they never make it. In fact, this is 2022. In 2020, I came across a client that got out of the markets in 2008 and still hasn't gotten back in. So like, you're missing like one of the largest bull runs that we've ever had, because of the fear or the uncertainty, the short-term volatility can get to you. So just remember, volatility is a price you pay to have investments. This is an investment quick take. If you have any comments or anything that you want to add, just leave it below. We like to keep this a conversation, and I'll see you next time.